Is Manulife One a brilliant way to pay off your mortgage faster, or a risky strategy that could cost you more in the long run? In this video, I'll break down how the Manulife One works, the common mistakes that people make, and the 5 key reasons it might not be a right fit for you. If you've heard the hype but want the honest pros and cons before making a decision, this video is for you. In essence, Manulife One is an all-in-one account that combines your mortgage with your bank account. Think of it like a big home equity line of credit that doubles as your checking account. All of your income gets deposited directly into this single account, which instantly pays down your mortgage balance. Every dollar you keep in the account, even briefly, is automatically offsetting your loan and reducing your interest. You can still pay your bills and make purchases from this account like a normal checking account. When you spend money, the mortgage balance goes back up by that amount. The appeal is that by funneling all your income and savings against the mortgage, you could pay off your home loan faster and save on interest, all while having the flexibility to reborrow up to your credit limit if needed for expenses, emergencies, or opportunities. If you want a full breakdown of how the Manulife One works, you can check out my full video in the description of this one. Now let's get into the reasons why the Manulife One is not a good fit for you. Manulife One gives you easy access to your home equity, which can be risky if you're not disciplined. Because your mortgage and spending are merged in one account, there is a temptation to treat your home equity like an ATM. In fact, many Canadians end up using their home equity line of credit as a big debit account for splurges, which can lead to trouble. If you tend to overspend or carry credit card balances, Manulife One could actually make things worse. Having a debit card attached to your mortgage might encourage impulsive spending, since every purchase just increases your debt. For example, if you see a $20,000 line of credit available, you might be tempted to renovate the kitchen or take a vacation. Without a strong budget habit, you could dig yourself deeper into debt instead of paying the mortgage off sooner. In short, this product rewards people who save and punishes those who overspend. So you need the willpower to stick to a budget, or Manulife One can backfire. Convenience and flexibility comes at a price. The interest rate on the Manulife One main account is typically higher than the rate on a regular mortgage, often about 1% above the going variable mortgage rate. This means you're paying a premium for the ability to access your money. There's typically also a monthly fee for the account, similar to a banking fee, which cannot be waived unless you maintain a large positive balance in some cases. If you already pay monthly banking fees, this might replace those, but it's still an added cost to consider. The big point here is that unless you consistently keep a lot of extra cash in the account to offset your loan, the higher interest rate and fees could cost you more than a traditional mortgage. In other words, the interest savings from your deposits need to outweigh the extra interest and fees that you're being charged. Otherwise, you'll end up paying more in interest overall. Borrowers who can qualify for much lower rates on a normal mortgage, or those who don't have the cash flow to bring down the balances, might be better off without the Manulife One. Unlike a traditional mortgage, a Manulife One main account doesn't require a structured blend of principal and interest payments. There is no regular mortgage payment that automatically reduces your principal. It's essentially an interest-only line of credit. Unless you make extra prepayments yourself, this flexibility can be dangerous for some people. If you're not proactive, you might end up paying only the interest each month and never actually chipping away at the principal debt. Some folks might be tempted to never pay that mortgage debt off, keeping it around longer than necessary. Think of it like the difference between a credit card and a regular loan. A standard mortgage forces you to pay down a bit of the principal every month, whereas Manulife One is more like a credit card. You decide when and how much principal you pay. If you thrive with structure or need the discipline of required payments, you might struggle with this free-form approach. The onus is on you to actively reduce the balance. Borrowers who aren't confident in designing and sticking to their own amortization plan could find themselves not making much progress on the mortgage principal, effectively prolonging their debt. Manulife One works best for people who consistently have extra cash sitting in their accounts. If you're living paycheck to paycheck or don't usually keep much money in the bank, this product may offer little advantage. Remember, the big perk of Manulife One is using your idle money to lower interest. But if you barely have any idle money most months, there's not much to offset. You might simply be paying that higher interest rate for nothing in return. In fact, someone who struggles to save could be worse off because the moment they deposit their pay, it goes towards debt, and they might feel tempted to pull it back out and spend it when expenses arise. In other words, if you don't have a cushion of savings or a surplus of income, Manulife One might not save you much or any interest, and it could even encourage unsustainable habits. For such borrowers, a traditional mortgage with its lower rate and fixed payments or a separate emergency fund might be a safer approach until your financial situation improves. With Manulife One, the strategy is often to pour all of your spare cash into your mortgage and become debt-free faster. That can be great, but it also means you might neglect other financial goals in the meantime. For example, if you're putting every extra dollar into the Manulife One account, you might delay investing for retirement or saving for a child's education, since any money kept out of the account is money not reducing your mortgage. You might pay off your 3 to 6% mortgage interest faster, but miss out on investments that could grow at a higher rate over the long term. Essentially, Manulife One can amplify savers to save more by paying down the debt, possibly at the expense of investing. At the same time, it can encourage spenders to spend more by making credit easily available. If you're the type of person who wants to contribute to RRSPs, TFSAs, and maintain a separate emergency fund, or simply like seeing a savings account grow separately, the all-in-one approach might feel counterproductive. Yes, your savings in Manulife One are working to reduce the interest, but psychologically, you might feel like you're having no savings since it's all mixed in with your debt. Not everyone is comfortable with that. It does require a mindset shift. Your emergency fund, for example, would just be a part of your available credit. You need to be okay with money moving in and out of your mortgage account regularly. If that trade-off does not align with your plans like investing or keeping cash reserves, then Manulife One might not be a good fit for you. Manulife One is an innovative and powerful tool, but as discussed, it's definitely not the perfect mortgage for everyone. It can be a game changer for the right person, typically someone with a solid financial discipline, a good amount of equity and cash flow, and a clear plan to use that flexible feature to their advantage. However, if some of the drawbacks we discussed resonate with you, for example, if you're worried about overspending, or you prefer the lowest possible interest rate, or you need the structure of a regular mortgage, then you might decide to stick with a more traditional path. The key is to honestly assess your financial habits and comfort level. I hope this critique has helped you understand the potential pitfalls of the Manulife One, as well as its promises. The goal is to make the best decision for your situation. If you feel you can manage these downsides and still believe Manulife One aligns with your financial strategy, I strongly encourage you to reach out. I've seen folks have tremendous benefits because of this product and would love to assist you in that process as well. Simply book a time in my calendar below to get started. If you like this video, you're gonna love this one as well.